Let's see here. All right, yeah, let's get started. But before we get started, I want to go over how you guys can participate and be part of the seminar. If you are logging in from your computer today, you'll notice two areas where you can participate. The chat box where everyone is currently typing, and also if you can find the menu bar, there should be 3 dots. And when you click open the 3 dots, you'll see the Q&A box. Please enter any questions you may have in the Q&A box and not in the chat box. And lastly, to be current on all of our future events, please add us on WeChat and Facebook if you haven't already. Feel free to use your phone now to scan the WeChat QR code to add us now. We will be coming out with some very exciting events, including some online networking events in the near future. All right, let's get started. Welcome to our CRA Zoom speaker event on commercial mortgage and market update. I am Yen Chang, a commercial real estate broker and assistant manager of Intero Commercial, also past president of CAREA. I'm honored to be hosting today's webinar and hope you find all the information today to be helpful to you. Jason and Andrew will be speaking on what is happening with commercial mortgages during this pandemic and a brief market update in the industry. I want to take this time to thank everyone for taking time to be here with a mindset of education, learning, and staying informed together. To briefly introduce us, the Chinese American Real Estate Association is a nonprofit organization established to promote the social and economic well-being of our associates and further the professional image of Asian Americans who are engaged in the field of real estate. We warmly welcome you to join and become one of our members. For details, please check our website, which is carea.org. This event is being recorded for our members who cannot make it today and can be found online on our YouTube channel or on the CRA website. We will also be emailing everyone the recording and slides the next day. So without further ado, let's welcome Jason Wang and Andrew MacLeod from Slatt Capital, a full-service commercial brokerage company in the Bay Area with over 48 years in the business. Let's welcome Jason and Andrew.
Well, thank you, Yuan, for the introduction. Hi, career members. Thank you for joining this webinar on Mid-Autumn Festival. 中秋节快乐. My name is Jason Wang from Slatt Capital. I've been working with working as the loan analyst for 3 years, supporting senior producers on loan placement and processing. And I'm starting to do my own loan origination as a producer, mortgage banker. During my career, I have helped close 190 loans with all different types of lenders, totaling an amount of $790 million. Today, I'll be delivering an informative presentation on commercial real estate financing. Topics will include the comparison between commercial and residential mortgages, market players, typical lender underwriting, and the interest rate indicators. Then my colleague, Andrew MacLeod, will be giving you an update on the commercial real estate debt market. So let's start with the comparison between the standardized residential mortgage and the customized commercial mortgage. I summarize the difference into 8 key terms. On commercial mortgage, typical max LTV is around 65%. And there are cases that they can go slightly higher, but it's not common to seeing that over 80% LTV on commercial mortgages without the secondary financing. LTV may have a significant impact to the interest rate, as it might lead to switch to a different lender with a more suitable loan program. The second point on here is the loan cost. Residential loan costs have been standardized and summarized into points and APR. However, that's not the case on commercial loans. Commercial loan costs and fees are more itemized and laid out on the table. Also, different lenders have different requirements, such as different third-party reports, whether legal is involved, and depends on the level of legal negotiation on the loan documents. The legal fees can exceed the original estimate at the end of the process. For simplicity, some commercial lenders roll the expenses into the loan, and that will result in a slight increase on the interest rate. For amortization, most commercial lenders can go up to 25 years amortization, which means slightly higher monthly payment and more principal paid down each month. There are some lenders can go offer 30-year amortization and interest only. And then going to the fixed term, we know that residential loans, we commonly seeing that can be fixed really long term, but most commercial lenders can only fix for 5 or 7 years. Only some lenders can offer fixed term beyond 10 or 15 years. So that also result in the next point is that the balloon balance at maturity. Since residential loan usually has a 0 maturity since they're fully amortized, and on commercial loans, because of the loan terms are often shorter than the amortization, most of the commercial mortgage has a balloon balance. It's important to think ahead about how to pay it off, either through a refinance with a new loan or disposition of the property down the road. For instance, it would be a bad idea to put a loan maturity at a year when you have a large lease rollover that will make the refinance or selling more challenging. The next big term here is the prepayment penalty. So we all know the residential loans have no prepayment penalties and can be paid down or paid off at any time. On commercial loans, that's usually not the case. Of course, there are lenders offer no prepayment penalties, but most commercial mortgages have some level of the prepayment penalties, or we call prepayment fees. A typical bank loan usually uses the step-down method, decrease from 5, 4, 3 to 1% year by year. And most life insurance companies use this method called yield maintenance, which is at the time of the early payoff, they calculated the premium of purchasing the US Treasury bond to replace the mortgage payment and balloon balance. This penalty can be very heavy if the payoff happens many years before the open window. And third method here is called the defeasance, often seen on CMBS loans, which means that the borrower hires a security broker to purchase market securities, which say risk rating to fulfill the future cash flow of the loan payment. There will be legal and security broker fees associated with the process. But on the bright side, if the market interest rate raised above the interest rate of the loan, the security will cost less, and the borrowers could possibly make a capital gain through this defeasance process. My advice to my clients usually on what's your future plan of the property. For example, if the borrower would like to sell the property in year 5, we should select the lender that can offer an open payoff window at year 5. Also keep in mind, most of the loans are assumable, so if the prepayment penalty becomes too heavy, with negotiation between the buyer and seller, the buyer can assume the loan and become the new borrower. And then going down to the next key term is the personal guarantee. On commercial mortgages, there are different levels of personal guarantees, starting from this no liability or standard carve out, and then go to partial of the loan amount or the full loan amount. Keep in mind the single action rule for California properties still applies. Among all the $4 billion loan portfolio our company service, the default only happened on a handful of loans. The lender always chooses the foreclosure on properties and now going after the borrower. And the last term is the cash flow analysis. Instead of the personal cash flow analysis on the residential mortgage, commercial mortgages is mainly underwriting based on the property income, with also consideration of the borrower's personal income. The next topic is about different type of financial institutions who lend on commercial real estate. The first group on my slide is the life insurance companies. The purpose of the investment is to invest their premium, making yield on long-term investment vehicles. In the end, to pay off their claims, which are also long-term obligations. So the key advantage of the life insurance company loans is that they offer very competitive long-term low interest rate. They can offer fixed term beyond 10 years or 15 years. And most life companies require to hire a certain percentage of the investment portfolio in commercial real estate debt. So they were active funding during the last recession, and they are still active funding during the COVID. And speaking of some of the disadvantage of the life insurance company loans is that they are more selective on the loan request. We're seeing that they are more competitive on low leverage, which is about or below 50% LTV. And with the long-term fixed loans, they also have this very heavy yield maintenance prepayment penalty, which we just talked about on our last slides. Lastly, I would like to mention that there are some life insurance companies specialized in the smaller loan space. They outsource their loan origination and servicing to local mortgage banking company like ours. So they will so they can decrease their overhead cost. That helps them to achieve the low interest rate. And this is a win-win situation for both the lender, the borrower, and also the mortgage banking company. The next group on here is sorry about my cat. Next group on the slides is the banks and credit unions. You might already be familiar with your commercial banks or credit unions that you have a depository relationship. The key advantage of this type of lender is that they are very competitive on preferred property types, currently on multifamily and industrial properties. They can typically go up to 65% LTV. They usually offer favorable interest rate for their existing customer. So it's always good to check with your banks, on your loan request. And most banks offer step-down prepayment penalties, and some federal chartered credit unions are required to place loans without any prepayment penalty. So most of them offer, short-term products such as, floating rate products, and also some of them offer construction loan and bridge loans. And we also noticed that, the banks and credit unions that during the COVID, they are not quoting as much cash out refinance requests. And we're seeing that they're easing this requirement recently. And during the first few months, of COVID, the large portion of the bank staff was pulled away to place PPP loan requests. So some banks stopped their lending completely. Now we're seeing, they're coming back to market as they have more available staff to work on new commercial loan requests. And also, since the banks have the short-term liability, which means the interest saving account, CDs or LIBOR, most banks or credit unions only can fix up to 5 or 7 years. And only a few of banks or credit unions can fix 10 years. Another important thing is that, the loan program for banks is different from bank to bank or credit union. They typically are doing very well in their credit box and not doing well outside their credit box. So it's our mortgage broker's job to help our client to identify the right lender to fit in the right box. The third group on this slide is CMBS or conduit lender, which most of them are investment banks. So they put together all different mortgages together in the securitization pool and convert them into mortgage-backed securities with different risk level and return, and sold the security to the secondary market. I have looked up the history of this creation of CMBS. It was a great way for small investors to participate in the large loan at a core market. This idea exists since the 1920s and becomes more regulated and popular in the 1990s. And the key advantage of the CMBS loan is that they are known to take higher risk, likely to offer interest only at a moderate leverage point. And CMBS loans are non-recourse, which is the minimal level of personal guarantee in any loans. Before COVID started, the CMBS loans is super hot and was the best performing lender in the market. However, after COVID started, they almost stopped lending and recently becomes available again. One major indicator of the CMBS loan is that they are totally driven by the security buyers and the composition of the securitization pool. For example, if a lender's securitization pool has a underweighted office participant, so they will offer better price on office product to balance the pool. And despite of the high leverage, interest only, and also non-recourse, good interest rate is low, all looks very attractive. CMBS loans has the least flexible, during the loan servicing and left alone, such as they require additional monthly reserve for retenanting and capital improvement. And they also have the cash flow sweep trigger in event the property income drop below a certain point or a major tenant moves out. So just be careful going into the CMBS loans and just hire a really good attorney for this situation. The fourth group on the slide is the agency. Agency is similar to CMBS on the securitization aspect, but handled by Fannie Mae or Freddie Mac. The government-sponsored agency only lending on the multifamily properties. You probably heard about those names from the residential mortgage-backed security, and this is a multifamily aspect. And agency loans have some standardized process and less restriction compared to the CMBS loan. And they're doing very well right now on the full leverage max cash out loan requests for multifamily properties. And also there are debt funds who are more specialized in bridge and construction loans with higher interest rate on higher risk project. They used to be very active on all different property types, and now we are only seeing them placing loans on multifamily properties. In the end, there are private notes for individuals as the lender. And you may wonder, how does a lender underwrite the commercial real estate loan? It's a lot different than a residential loan. And I summarized it into 3 key metrics: property cash flow, leverage, and sponsor strength. So the first one is the property cash flow. Usually the lender are more focusing on the steady net operating income can be produced to the property by referencing the historical income and expense. And they're not much taking consideration of the landlord's projected potential growth. And for some lenders, they are more comfortable with long-term lease with good credit tenant. Some lenders are more focused on the ability to re-tenanting the property. The next metric is leverage. Lender consider loan to cost to make sure the borrower has enough skin in the game. And the lenders also consider loan to value as well as the estimated loan to value at loan maturity to make sure their loan can be paid off. The last metric I have here is the sponsor strength, which the lenders are looking for the sponsor's experience for operating similar properties. This is more important when the property has weaker tenants and a large lease rollover. Some lenders perform a global cash flow analysis on the sponsor as part of their underwriting as well. So this part is similar to the residential loan. The last part of my presentation is the indicators to the interest rate. For most lenders, their interest rate is bounded by their operation cost and fluctuate with the market. I know a lot of lenders are using the US Treasury plus a spread as their pricing model, but they're really comparing actually with the bond market. So for example, for a super safe commercial real estate loan, the interest rate should be, similar to a credit rated bond. So I have a lot of data for the this orange line, which is the Moody's A corporate bond, and this green line is Moody's B corporate bond. So a super safe commercial real estate loan, the interest rate should be in between these 2 lines. And then if it's for a little bit riskier property, it should be slightly above this green line. And in March, when the COVID started, despite of the drop of the US Treasury rate, the bond market really panicked, and so does the interest rate on the commercial real estate loan. So you'll see this really big spike in March, and it's so that's the same thing we're seeing on commercial real estate. We're getting really high interest rate on our quotes in March. And now the bond market, falls back to normal and even have a slightly better interest rate than pre-COVID. During COVID, our company is still very active placing loans and obtaining loan quotes. In this environment, we have closed 128 transactions with $451 million loan volume. I'm going to hand a presentation to my colleague, Andrew MacLeod, a very experienced mortgage banker, for a commercial real estate debt market update.
Oh, thank you for the compliment, Jason. Hi, everyone. Good afternoon, good evening, wherever you may be. As Jason said, I'm Andrew MacLeod. I am the Vice President, Slatt Capital. I've been with the firm since 2012, so just about 8 years. I started as an analyst, similar to Jason's role, and I did that for about 3 years, working on various property types and supporting various multiple producers. And then for the last 4 or 5 years, I've been doing origination on my own as well. So my role as a producer or originator, whatever you want to call us, is to speak with you, your client, the borrower, understand what they're looking for on the financing side, work with your sales broker or your property manager, figure out everything that's going on with the property, figure out our best strategy for finding the right financing for you, and then we take the loan out to the market to the various lender types that you just saw and hopefully find something that will work and get the job done. So what I'm going to do is I'm going to give you a quick narrative just on, what has happened in our market with COVID, before, during, and where we are now. Then we're going to take a closer look looking at each specific property type and some of the challenges that it had during COVID and where lenders are looking at them now. And then finally, we're going to finish with a little insider knowledge. You're going to get a peek at our Salesforce dashboard that our company uses to track all of our loan quotes and rates and lender updates and so forth. So the first is an overview on the COVID. Let's think of the timeline of what happened this year. So as Jason said, in the beginning of the year, everyone was going gangbusters. Business was great. Our firm was probably on pace to do its best year ever. All the lenders were active. Construction loans were being done. Cash out was okay. It seemed like if you needed a loan, you could probably get it unless there was something wrong with the property. There was lots of liquidity in market, and I would describe it as the perfect condition to get financing because we were at all-time historic lows. Lenders were flush with cash. Everyone thought everything was going well, and then we all know what happened. So when COVID hit and all the lockdowns started coming into place in March and April, lenders really didn't know what to do. Some lenders just stopped lending altogether. They wouldn't even quote deals. Some stopped for a couple weeks, some stopped for a month. We weren't really sure, and lenders didn't know what was going to happen with COVID, what was going to happen with the economy, and they got pretty skittish on putting out any money at that time. As Jason mentioned in March, we saw a spike in interest rates. A lot of deals are getting done in the 3s, and back in March, they were getting done in the 4s, close to 5, and that was considered market pricing. There was just too much uncertainty going on in the market for lenders to give their best pricing. Something to keep in mind is in January and February, the 10-year Treasury, which a lot of lenders use for their pricing, it was in the 170 range, and only a couple months later, it dropped 100 basis points down to the 0.7 range. So a big drop off, which of course made lenders even more nervous. So some lenders will price off of an index like a Treasury, and then they'll add a margin on top of that. You add the two of those together, and now you have your all-in coupon rate. Well, when the Treasuries were going crazy, a lot of lenders stopped doing that. And if they were quoting deals, they were quoting all-in rates. They didn't want to put a spread out there, have the market go up or down or all over the place, and then be stuck with a loan they might be losing money on. So that's another thing we saw is lenders were quoting coupon rates, all-in rates, and setting floor rates, which tended to be in the 4s. The other thing that happened during the immediate aftermath is that lenders were extremely picky on the type of deals and the type of property types they wanted to work on. We all know what happened with hotels in the hospitality industry. During COVID, it was nearly, I'll say it probably was impossible to get a hotel loan done. And unfortunately, that is still probably the case today. That group, that property group, has a long way to go before it's really going to rebound, unfortunately. Strip retail also was being looked at very cautiously. And by strip retail, I mean multi-tenant retail. This is literally any retail space that has more than one tenant. So this could be your grocery anchored shopping center. This could be a strip center just with a bunch of small mom and pop tenants. Or this could be two national brands right next to each other, like a Chipotle and a mattress firm. Just because it was multi-tenant, lenders were more nervous on it. Office is in a in-between space right now. It was very hard during COVID to do it. It's getting a little bit better now, but it's still very tricky. And that's because of basically what we're all doing right now. Instead of being in an office, we're on Zoom. So there's a big question on what's going to happen with office. And during COVID, it was nearly impossible to do. And right now, it's still tricky, which we'll touch upon a little bit later. The two property types that have really stayed pretty strong through COVID and now are industrial and apartments. For a little bit, lenders were a little nervous on apartments. People weren't sure what COVID was going to do to renters. Are their jobs going to get shut down? Are they going to be able to make money to pay rent? How are collections going to be affected? And then we had the stimulus checks kick in and things seemed to stabilize. And for the most part, a lot of apartment owners saw better than expected collections as they went into May and June. And now it's pretty stable. Industrial has always been highly sought after. It was doing well through COVID. It wasn't really affected that much. And that really ties into, distribution centers and data centers like supporting Zoom calls or Amazon deliveries that we're all doing now. So that did well. So the picture now, we're looking at it now that we're officially into October. I'd say we're getting back to what I would call normal. We're close to where we were in January and February, just regards to deal flow and activity that we're seeing. The rates have definitely stabilized and improved way better than we were in March. Most deals I'm seeing across all property types are going to be in the mid 3s to high 3s, which is still very cheap money, especially when you're talking about really long-term rates. And treasuries remain low right now, so it is a great market to get deals done. You just have to watch out for some trickier requests. It's still pretty hard to do any cash out. That's something that lenders are being strict on still. Construction loans are pretty challenging and really probably only doable if you have a pre-leased project or you're pretty far along in the process and you can show that you know what you're doing, you have financial strength behind you and you've done this before. The other thing where lenders are getting a little bit stricter is for a borrower that is picking up their first commercial property. It doesn't mean it's not doable, but they may be a little bit more restrained on leverage. They may want to ask you a few questions on your experience doing this kind of property, but lenders are always worst case scenario thinkers. So they always want to say, well, if you live in California, borrower, and you're buying this IHOP in Florida, if something goes wrong, how are you going to manage that? So you can imagine how they might be a little nervous in that situation. So next, let's dig into the property types. And on these slides, you're going to see an overview of what our company is doing. So everything that you see in these next slides is over the past 30 days. On the right, you can see what this makes up for our production and our firm. So in this example, we do about 25% of our total business in the single tenant space. If you look on the left, you're going to see the breakdown of the lender types are in this space. The middle is going to show you the average interest rates. And then underneath that, you're going to have the loan to values. So the key takeaways I would take on here is overwhelmingly, a lot of our deals are being done with the credit unions and the banks. And as Jason mentioned, there's some specific factors to these types of lenders that borrowers really are attracted to. They have good rates. I would say anything in the 3s is a good rate. They offer good cash flow options because they can usually go up to a 30-year amortization, especially credit unions. So if you have a borrower that's looking to maximize his return every month, well, you get a 30-year amortization that'll help bring down that monthly loan payment, and now you've improved your property cash flow. And one of the strongest aspects for a bank or credit union is the way that they're going to structure a prepayment penalty. Most banks are going to have some form of a step down percentage, 5, 4, 3, 2, 1, something like that. And most credit unions, nearly all credit unions, in fact, usually don't charge a prepayment fee. So if you or a client is looking to acquire a property and you're not sure when you may sell it or if you need to pay off that loan early, looking at our bank or a credit union is a pretty good option just because of that prepayment flexibility. Now underneath that, we have life insurance next, but this is really only for the more conservative loans, the stronger tenants, the longer leases, or people that are looking for something longer than 10 years fixed. We're quoting deals right now in the retail space with life companies up to 25 years fixed, but I only recommend people do that if they know they're gonna hold the property long term, because as Jason mentioned, you have yield maintenance to watch out for, which you don't know what's that gonna be until you decide to pay off a loan early. So you really take the risk of the market. So again, life insurance, more for conservative requests. Here we go. Multi-tenant retail, this is tough. It's really tough to say, how this is doing right now and how it's going to do. We're looking at the activity in the last 30 days in our firm across all producers, and we don't have much in here because lenders aren't looking at or really aren't considering a lot of these deals right now. If you have a multi-tenant retail center and you have a tenant that was shut down due to state or government mandates, or perhaps they weren't shut down, but their business has declined so much that they've reached out to a landlord and asking for rent abatement or rent deferral, that's going to be a really hard story to get a lender comfortable with unless you're going to provide recourse on the loan, which is a personal guarantee, or there's some other mitigating factor that gets the lender interested. Perhaps the leverage is so low that you get interest, like for instance, a life insurance company would only be a player if it's very low leverage. Now we're starting to see these deals and lenders are starting to be more open to them, but the first question out of any lender's mouth is, you know, who are the tenants, who's actually open right now, who was given rent relief, and, you know, I need the whole story before I'm even going to look at this thing. So it's a tough space right now. So that's kind of the best way I can put it. Multifamily, as I mentioned before, the lenders were a little cautious, you know, when we first had all the lockdowns hit. But now that collections look a little better than expected, they're very active in this space, and they're aggressively going after this space. A lot gets done with bank and credit union for the various reasons we mentioned before. Agencies are a great option in this space, and this is the only space they play in. If you had a request that someone was looking for high leverage and a great rate, I think agency would be the first call. You're going to be able to get a rate probably low threes for a 10-year fix, maybe even the twos if it's a conservative request, and you can get good cash flow and potentially some flexibility on the recourse. Now, multifamily is definitely one of the more highly sought after property types with lenders. And when we think about, you know, why is that going to be the case? Well, as you can see, people are spending a lot more time at home, and it looks like it's going to be that way. And before everything went down, housing was always in short supply and always demand. So it looks like a safe long-term bet for a lot of lenders. The next is office. This is similar to what I would say of a multi-tenant retail space of we're not quite sure how it's going to pan out. It really breaks down into two buckets. If you have a strong tenant with a long lease in a good location, and you have a strong operating history, and you've had no COVID-related issues on rent collection, you can probably get a pretty good rate. We recently signed up an office here in the Bay Area with one of our life companies, and the rate was in the mid-twos. So if it works, you can get a good deal. Now, if the location isn't too good, or perhaps it's in a location where, you know, maybe downtown San Francisco, you know, it's kind of a ghost town, lenders might be a little nervous on that. Or if you have a multi-tenant office with a lot of smaller tenants that have reached out for relief and may not have the financial strength to get through how long the pandemic's going to last, or a recession that comes afterwards, that could be very tricky. So it really depends what's going to happen with COVID, to be honest. Are we going to get a vaccine? Are people going to go back to the office like we're used to? Are they going to go back and reduce employee counts? You know, what is office going to look like? So right now it's a little hard to say what office is going to look like, but lenders will look at it. And if it's a strong conservative request, there's definitely aggressive options out there. Industrial, like I mentioned about multifamily, is a very highly sought after space. I know from my personal use, doing a lot of Amazon orders, a lot of grocery deliveries. So people need warehouses, people need distribution centers. These Zoom calls are housed on those data centers I mentioned before. Self-storage is also a very sought after space. Industrial is probably poised to be the strongest asset type coming out of COVID, just based on where we're seeing and how they're living their life right now and how they're getting means to get the things they need in their life. Now, as you see in the chart, the vast majority of what Slatt does in this space is with our life insurance companies. It may be a little misleading because most of the requests that we get on industrial are going to be lower leverage. They are in existing properties that have strong operating history with strong operators. But as you can see, you know, these rates in the middle here, you know, low to mid threes, that's on the better end for pricing. So very aggressive and a very highly sought after property type for lenders. This next chart is more just a visual to kind of take in, you know, as I kind of go over it. But really, this is just looking at, okay, for the past month, where are the different lender types giving leverage and rates across the different property types. So if you're looking at multifamily, well, agencies are great performers there. They're giving good rates and they're giving, you know, high leverage. Life companies are giving some of the lower rates, but they're all going to tend to be more conservative, as you can tell if you see the LTVs on the right there. Banks and credit unions, you know, they kind of are going after everything. They're working on all property types, as you can see, and their pricing is always, you know, pretty comparable, especially if you have a strong relationship with them already. But remember that it goes beyond a rate and an LTV when you're trying to put this together. So when you're first talking about what kind of financing do you need to have a conversation to discuss the other pieces that go into it, as Jason mentioned. Is a personal guarantee okay? Or are you trying to find non-recourse? That's going to push you towards one lender or push you away to another lender. Are you looking for that flexible prepay? You know, and this ties into what Jason was saying about what are your long-term plans with the property. If you might sell, well, you want to stay away from CMBS and you want to stay away from life companies. And what else could you possibly need to watch out for? Well, certain lenders, in order to do deals, are now imposing bigger debt service reserves on some properties, or they may require escrows, you know, tax or insurance escrows. Certain lenders need those, certain lenders don't. So really, it's a cohesive, you know, 360 approach to looking for the best financing. It's not just rate and LTV, even though that's what you typically see. This last page is that secret sauce I was telling you about. This is a snapshot from our custom Salesforce database. So of the 24 producers we have and our analysts, everyone in the Slatt company has access and inputs all the data that we receive. So if we've closed a deal, if we have a deal under application, or if we've received a quote on the deal, we put it into this database. The dashboards get created to provide live information on what is coming in. So as you'll see, it's a little small, I apologize for that, but on the left we have the lender and property type average rates, looking at the last 30 days. In the middle, we have the last 60 days. On the right, we have the last 90 days. 30 days is probably not too much data to really go off of. You see that there's a few less options in here. So I would really probably look at the last 90 days. And the big takeaway here is in the last few months, it looks like the majority of property types are getting quoted, we're getting done. And where's the market pricing in most deals? Well, I'd say in the 3 to 4 space. If you have a very conservative request with a strong borrower and a strong tenant, you can get down in the 2s. If there's something a little tricky with your deal, or maybe COVID has affected the property, you might be closer to the 4s or the 5s. But in general, pricing right now is in a very good place historically, and I think it's hopefully rebounding, but we'll see what happens. That wraps up my portion, so I'm going to go ahead and move us to the Q&A section, and I will pass it back to you, Jan.
Awesome, guys. That was amazing. Lots of information. Just so you guys know, I've used Slatt Capital for a lot of my clients. I remember back in early 2000s, we did a medical building, and we're dealing with Dan Friederberg from your office. And these guys went above and beyond. We had to close a CMBS loan literally before the end of the year. And this was Christmas season. We're meeting with the clients. And I mean, we're at their office. He's with us. It's you know, December like 22nd, and you know, everyone's like working their butts off. And I mean, hands off to you. Any deals that I can refer to them, I always refer my clients to them, just because I know they go above and beyond, and you know, they're just a great source for commercial financing. So yeah, with that in mind, if anyone has any questions, feel free to punch in, you know, your questions in the Q&A section, and we could kind of go over, this is a great time to, you know, these guys are always busy. So this is a great time to, you know, have questions for them, and they'll answer them for you. So let's take a look and see what we have. Hold on. Okay, I think I got one here. Hold on. All right, so here's one that came in from someone. So which property types are getting the most aggressive rates?
I guess I can start with that, Jason, if you want to add something after. So I think it depends on the property type, and then within the property type, it depends on the tenant. So as we were discussing, industrial and apartments are definitely getting the best pricing. That doesn't necessarily mean any industrial or any apartment deal is going to get, 2.5 on the rate, right? But in general, those get the best pricing. When it comes to something like retail or even office, it's going to come down to the tenant. And in particular, in the retail space, the best pricing right now is going to be with the COVID-proof and Amazon-proof tenants that a lot of people are going after. Investment grade tenants are always highly sought after by lenders. These are any tenant that has a BBB- or better rating. You can think of your 7-Elevens, your Dollar Generals, Firestones, and stuff like that. So better, stronger tenants will get better pricing.
Yeah, and adding to that, it's just when lenders before COVID, they are more comfortable considering the properties, consider multi-tenant properties with retenant, good location. They assume they can retenant the property when there's a vacancy. That's not the case. Right now, it's really the tenant driven and just depends on which tenants in there. And we're seeing that, the most competitive ones are, very good corporate credit, and they have doing very well during COVID. And with a moderate or to low leverage, that's the lowest interest rate we're seeing.
Great. Here's another question. This is from a residential realtor. If we were to offer on a commercial property, how many days should we put in the loan contingency?
So I think typically, yeah, it's the most of the, so speaking of the process of commercial loans, it's always good to have the appraisal phase 1 report delivered before you remove the financing contingency, as long as the lender's approval. So the report typically takes 2 or 3 weeks. So what we're seeing typically our financing contingency is 30 to 45 days to remove that. And then the total closing time frame will be 60 to 75 days, or shorter than 45-day closing overall.
Okay, great.
I'll add one thing on there. What I usually tell a lot of my clients, and especially when I'm working with sales brokers for 1031s or something like that, is I like to work backwards from the date that you anticipate signing a purchase contract. Keep in mind, it's going to take a while to get the quotes and to get the feedback. And then when you have the feedback, it's going to take you or your client a while to figure out which option they want. And then it's going to take the lender a few days to generate a term sheet. You're going to want to review it. Then you're going to be signing. You're going to have your good faith deposit ready to go. So what I always tell people is, let's talk as early as possible, because if you're going after a specific property and you have to close it in 30 or 40 days total, there's lenders that can do that, but not all of them. And that's going to help shape how we're looking at the financing. I always recommend, start a file on the borrower first when you're doing a purchase. So that's usually just jumping on a phone call with me or Jason, with the client, a broker if they're involved, getting a little background on who they are, getting a financial statement, getting the borrower file ready to go, so that when you find that property, now we have everything completed for you. And then it'll take us, a week or so to get you some quotes and get you to that final loan application. But I always tell people, make sure you are ready. You have a loan application reviewed, you're ready to sign it, and that you sign it no later than the day that you execute that purchase contract, because that is day one. That's when the clock starts tipping. So let's work early as we can.
No, that's great. That's a great idea. Here's another one. Do you think there will be a lot of foreclosures coming in the next year? And which industry would that be?
So I'm not sure is my most politically correct way to put it, but what I've seen, especially in June or July in that time frame when people were kind of getting used to lockdown, what I saw is a lot of borrowers that were sitting on the sideline asking that question. They said, well, this is a pandemic and there's got to be a recession. There's got to be some deals to be made. And for the most part, people didn't see that. A big kudos to the lenders is that when people had issues with their properties and reached out for help, a lot of lenders, a lot of life companies, a lot of credit unions and banks really stepped up, helped people figure out payment plans. You know, it didn't automatically go in default. Unfortunately, that's not the same case with CMBS. The borrowers in CMBS have been treated pretty poorly, in fact. But it's a great question that a lot of people keep asking, and I'm inclined to think not, just because it seems like everyone's sort of working together to get through this, but who knows?
Yeah, this is a crazy time, crazy time. Hey, can we scroll back to your contact information? Because I think some people are asking about your contact info. So I just want to leave it up here because I know some people probably need to leave first, but we do have a couple more questions. Yeah, perfect. I'm glad you guys got that up. Let's see. How are lenders reviewing owner-user loan requests?
Not to beat a dead horse, but it really ties back to how they've done during COVID. If your business has been doing well and you haven't had a big dip, then you should have a lot of options. You should get what is market pricing. You should be able to have several different lenders looking at your property. A good example of a deal I'm working on right now is one of my clients has a food distribution service in South San Francisco. A very generic building, 20,000 square feet industrial. If he were to just close his business and bring in a third-party tenant on a new lease, you'd have every lender probably jumping all over it because of the location. Unfortunately, his business went from grossing over 10 million a year to now down to 2. And the lenders all said the same thing. How's it been going during COVID? I need to see the last 3 years of financials, and I really need to see all the 2020 info, and I want it by month. When we dug into it, he was not performing well, and he's actually been operating at a loss since April. So when we went back to the lender with that information, several just said, I'm sorry, I got to back out, I can't do this. There were a few that were still interested, but a good example on how a non-owner user deal can change when you have a bad or a struggling business in there, where initially we had quotes with 10-year fixed, 30-year amortization. Some lenders brought the amortization down to 25, and every lender wanted the borrower to sign a lease with himself and then personally guarantee that lease so that the lender had guaranteed income coming in. They also wanted to have, I believe, 6 to 12 months of debt service reserves funded day one. So if your business is doing well, you should be able to get a pretty good loan. If you've been affected by COVID and severely affected, your options are going to be pretty limited right now. But it's all case by case, deal by deal.
And also adding to, besides the balance sheet, there are also SBA lenders through the SBA agency. This market is half open, and before a couple months ago, they're so swamped with helping on the PPP loan request. Now they have more availabilities for helping out on the new loan request, but it's still the same situations if they analyze the business by case. And if they're doing well during COVID, then sure, I think there's definitely a loan option out there. But if the business already have a really bad experience during the COVID, then it will be unlikely to get a good long term.
Great. I have a personal question. My family's in the hospitality And I know hospitality is getting hit really, really bad. But there's also a lot of investors on the sideline waiting. Are lenders looking at financing these deals right now? Because I mean, hospitality is getting killed. I feel like they're getting hit probably one of the hardest in this pandemic. What if they are lending? Does it need to be franchised? What are they looking for?
Yeah, so for any hospitality, I would say the more well-known the flag, the hotel brand is, the better you're going to have. The lower the leverage, the better, of course. If the numbers are kind of what we expect, I think it's going to be pretty tough, but there are certain ways you can get around that. Maybe if there are non-hospitality properties available that could be cross-collateralized, and then you could structure some release provisions or something like that when hopefully everything rebounds. That might be a good approach to go to. I think any lender that would be interested in hospitality would definitely, be recourse with a guarantee right out of the gate. Lenders got hit real bad with hospitality. They were the first people calling, and all the ones that we work with in service did a great job of giving those borrowers relief and figuring out plans, because they just knew, it was out of their control. So it's always going to be case by case. But I would think it's going to have some structure to it, and you may have to bring in an additional property or something like that, or a strong guarantee behind it or something like that would be my best guess.
Got it. I'm going to probably be the last question. Do you guys provide construction financing?
Potentially.
Yeah, potentially. That's the right question answer. Yeah.
Yeah.
Depending on the product.
It really.
Yeah.
Exactly. If you were trying to do a spec deal right now, it'd be really hard. And if someone was available, you're going to be in the hard money space. It's going to be 7, 8, 9, 10%, something like that. Your best shot on a construction loan is something where you've gone through the entitlements, everything's figured out, you got tenants, leases ready to go, everything is still moving forward, even COVID. Another approach is if you're looking beyond the construction loan and you look at a construction to perm. That may be something that may be doable for someone with a construction request. A lot of our life companies are good in that space, where they'll give you a fairly market pricing. It won't be as low as possible, but it would still be, my guess, 3.4s if you're adding the perm component into it. So there's maybe a different way to look at it than just the construction, but it's pretty tough. And we do get a few construction requests here and there, and the feedback is always, it's going to be pretty pricey to get the debt on it right now. So yeah, that might be one of those things where if things are looking good, let's all cross our fingers and hope we kind of get back to normal life. But otherwise, it's pretty challenging.
And the other thing, another sector of the actually on multifamily construction loans, there is the HUD loan and FH. That was one of the construction loan guaranteed by FHA, going very high leverage on. I think it's more of a how do I put this? More of the for developing the city at the opportunity zone, or in that category. They are very active, but just the process is very long. They usually take 6 to 12 months to get it from the application to funding, and that's pretty much the same timeline from the entitlement to starting ground up construction. Those spaces are very active and offer really good rate, but that's only suitable for large multi-family development.
Got it. Yeah. So I think a lot of people are more asking about for those residential developments. Seems like there's a lot of entitled land entitlements out there, and there's opportunities. And I think there's some of those builders that are looking for those. So that's great to know. So if everyone looks on this slide, this is their Jason and Andrew's contact information. Feel free to email and reach out to them directly for any of your commercial finance needs. And we will also be sending out this entire presentation as well as a recording for everyone first thing tomorrow morning. So with that said, let's close it with a special thank you to Jason Wang and Andrew MacLeod for sharing some great info today. And thank you everyone for your participation. Have a great rest of your week and stay safe.
Thanks, everyone.
Thank you.